Everyone thinks a bull market makes trading easy. It doesn't. It just makes your mistakes more expensive. Right now, the market is giving us some of the best setups we've seen in months, and most traders are either missing them completely or trading them wrong. So I'm going to show you exactly how I'm approaching this market right now. One of the biggest traps in a bull market is that everything looks like a setup. When the market is ripping, suddenly every chart looks clean and every stock looks like a winning setup. But this is the most dangerous mental state you can be in as a momentum trader. Your standards don't go down because the market is up. If anything, they should go up as well. In a strong bull market, there's so many good looking setups that you can afford to be more selective, not less. The traders who blow up in a bull market are not the ones who miss. They're the ones who start taking 2 and 3 star setups because everything feels like it's going to work, and everything will work until it doesn't. And when it turns, the traders who were sloppy are the ones left holding the bag. Your 5-star criteria does not change because the market is green. You still need the prior move, the tight consolidation, the volume correction, and the clean breakout. Every box still needs to be checked. A bull run is exactly where real money is made, but only if you approach it correctly. A bull market with momentum names setting up is exactly what your system was built for. The 10 and 20 moving averages are going up, SPY and QQQ are above both of them, sectors are rotating into strength. This is the green light environment. Most traders know how to take a trade, but very few know how to hold it long enough to make real money. In a bull market, momentum names don't just break out, they run. And the biggest mistake is to sell too early because you're not used to wins of that size. My trim system exists exactly for this reason. Sell a third of your position into strength, move your stop loss to break even, and trail the rest with the 10 moving average. That way you let the market tell you when the move is over instead of trying to guess the top yourself. In a bull market, your job is not to find good trades. It's to stay in them long enough to actually get paid. Sector rotation is everything right now. Not everything runs at the same time, even in the bull market. Money rotates. Right now, certain sectors are leading and others are lagging. Your entire edge as a momentum trader is to be in the right sector at the right time. The mistake most traders make in a bull market is that they find a sector that's working and stay there even when the money starts moving elsewhere. But here's what you should do. You should always look for group strength first. Multiple names in the same sector breaking out at the exact same time. That's where institutional money is flowing. Then, when you find the leading sector, find the leading name within that sector. The stock with the biggest move, the cleanest setup, and the strongest relative value. In a bull market, everyone makes money. But in the bull market with the right sector, that's exactly where you outperform everyone else. And this is why patterns alone are never enough. A perfect setup in a weak sector will underperform a decent setup in the hottest sector every single time. FOMO is also louder in a bull market and more expensive than anything. When everything's going up, watching a stock runs without you feels physically painful. The temptation to chase is at its absolute highest in a bull market because the market keeps proving you right. The stock you didn't buy keeps going up. But here's what nobody talks about. In a bull market, chasing is more expensive than in any other environment. And that's because the moves are bigger, the extensions are further, and when they pull back even harder. So your rule doesn't change. If you miss the breakout, you missed the trade. And in a bull market, there are more setups forming right now than at any other time in a year. You literally do not need to chase anything because another 5-star setup is forming somewhere else on your watch list. The best traders in the bull market are not the ones catching every move. They're the ones who stay disciplined when everything around them is screaming to buy. But it's also very important to know when the bull market party is ending. Most traders ride bull markets up and give everything back on the way down because they never saw the signs. Your filter should be simple and non-negotiable. Watch QQQ and SPY, specifically the relationship between the 10 and 20 moving averages. When individual momentum names starts failing their breakouts, even when SPY is holding up, that's your first warning sign. Money is rotating somewhere. When SPY itself is breaking below its 10 moving average, you start reducing exposure immediately. And when the 10 moving average crosses below the 20 moving average on SPY or QQQ, you go to cash. As simple as this. You don't need to predict when the bull market ends. You need to have a rule for when it does and follow it. And here's what I'm actually doing right now. At the time I'm filming this video, the hottest sector in the entire market has been memory chips and semiconductors. The entire market is up over 10% in the past month. You can afford to be aggressive if you have somewhat of a profit cushion. And when I say you can be aggressive, I also don't mean full port every setup you see. I mean that if you risk, for example, a quarter to 0.5% per trade, you can now risk up to 1% per trade on worthy setups. And that's just because the market conditions are better now than they were a couple weeks or months ago. Since I'm now risking more and taking more trades, I also have more exposure in the market in general and in individual names. But there's also a limit to this. I don't feel the need to hop on margin right now, but I also feel pretty comfortable having up to 100% of my cash invested in the market. market. Although, per individual name, I would not want to go above 20 or 25% at most exposed in that single name. It also does not mean that I have 20% of my account exposed per position. Obviously, I have some that have less exposure. All of that will depend on your sizing. As for my open risk or open P&L, I'm very comfortable between 5 and 10%, but that will obviously change depending on your personal risk tolerance. That open risk or open P&L percentage is very important because when you go in a bull market, when you go in a bull run, your account usually has more unrealized profits. So when it pulls back, it probably will pull back a lot harder than what you're used to. Although the majority of it will be unrealized profit, you still have to be very cautious about it because it can definitely make you anxious. Right now, the market is giving us setups on the silver platter. My job is to execute my process cleanly and not get greedy. I trade live and alert all my positions every single day in my Discord. The link will be in the description if you want to take advantage of this market. This is the way to do it. A bull market rewards discipline just as much as a bear market does. Maybe even more, because when everything looks like it's going to work, the traders who stick to their process are the ones who compound. And the ones who get sloppy or greedy are the ones who give it all back when the market turns around. And everything I just talked about, the process, the system, my trading strategy, the mindset, the risk management, it's all available on this channel. So leave a like and subscribe if you want more of these videos, and I'll see you guys in the next one.